Hi everyone, I'm Ravi Handa and welcome to another episode of Desi Fire podcast. On this channel, I talk about financial independence and early retirement. And a very important part of an early retirement portfolio is that it needs to last very long. Traditionally, you can argue that retirements last 20 years, 30 years, but if you retire early, your portfolio needs to last a really long time. And that's precisely why I'm planning to add some gold to my portfolio. I don't really have much gold in it. So I have a little bit of gold. I'm adding some more. I'll talk about my journey with gold in the end of the video. But before that, I'd like to talk about three main points. One, why you should invest in gold in the first place. Two, why you should do that now. Why is, let's say, late 2024 when I'm making this video. I'm making this video in October 2024 end. Why is now a good enough time? And three is, how do you actually invest in gold and which one is a preferred option over there? So these are the three main things, and then I'll talk about what I have been doing. So first of all, why should you invest in gold? When you're looking at a portfolio that needs to last a long term, like any early retirement portfolio, you have to have a mix of different assets. Most early retirement portfolios will have equity and debt. And that's what I have. Debt is also known as fixed income these days. So if you have too much equity, let's say your 100% of your retirement portfolio is in equity, the problem is going to be that it's going to be very volatile, and you cannot have that in your retirement. The other end of the spectrum would be that you put your entire money in fixed income, in debt mutual funds, PPF, FD, and those sort of instruments. The problem there is going to be that while it will not be very volatile, it's not going to grow very fast. And you need both of them. That is why you need a mix of both of them, and that is why you need both equity and debt in your portfolio. I believe the ratio could be anywhere from 50-50 to 60-40 to 70-30 to 80-20. That depends on the individual and how much money they have. But they'll need both of them. So I believe that argument is fairly settled. But is that enough? Well, maybe it is, maybe it isn't. But if you add gold into the mix, it adds as another hedging instrument, a load balancer, because it's an asset that is not correlated to equity. So when equity is doing very well, it's not necessary that the gold is also doing very well. So it's possible that the equity is going up, gold is going down, equity is going down, gold is going up. It balances your portfolio a little bit. On the debt end of the spectrum, the debt will keep growing, the fixed income part. Maybe it will grow at 6%, maybe it will grow at 8%, maybe it will grow at 2%. So the rate of growth can vary, but it will keep growing. But it will never have very high growth periods. Gold, on the other hand, will have high growth periods. I believe just over the last year or so in India terms, gold has given 25% or maybe a little bit more than that in returns. Well, over the last year, everything has done well. I believe the equity markets have given maybe around 40 odd percent of returns. Definitely, they have done better than gold, but both have done very well. So that's possible. But if you look at 2020 as a period, when the stock markets fell drastically, and stock markets tend to do that they fall drastically, in that part, gold had done well. So if you had gold at that point of time, the overall impact on your portfolio would have been lesser, because there was some portion which was doing well when there were other portions that were doing bad. That's the entire hedging argument that exists. The other part is that just for the hedge, should I compromise on returns a lot? No, you don't need to. At least in India, gold has given more or less equity-like returns over the last few decades. Because what happens is gold moves on a global level. So the price of gold is primarily decided in the dollar. So maybe in terms of dollar, it does not give that much amount of returns, but the Indian currency depreciates with respect to the dollar. And because of that, the returns, especially in India on gold, are significantly better than what you would see in a lot of US based videos, or when you will see Warren Buffett talking about how gold might not be a great place to invest in. And a lot of other US based media says that, okay, equity is the way to go. I do believe that equity does very well as well. But the point that I'm trying to make is that gold gives you fairly good returns. I believe if you look at any 10-year period, you can expect something like a 10 to 11 odd percent return on gold. Now that's the sort of average. Now, if you're if you have bad luck, there will be 10-year periods when it has given 0% returns as well. So yeah, luck plays a role into it. But when you're making a decision, you have to make a decision based on some facts, some data, which is on an average it would do around 10% in 10 years. So, but that being said, so that's primarily the reason that in India, it not only acts as a hedge, it also gives you fairly good returns. So that's the broad argument of gold. There is one more argument against gold, that gold has been proven to be a store of value over thousands of years. Say, for example, gold was very well accepted across the globe 1000 years ago. If you go back 200 years, the reserve currency of the world was, in the 1800s, I'll believe it will probably be the British pound, where everyone said that, okay, yeah, British pound is supreme. In the 1900s, I think dollar became the supreme currency of the world. In the 2000s, the century that we are living in, maybe the dollar continues. I do believe that the dollar will continue for some time. Maybe there is a new currency that becomes the global standards. Maybe it's the yuan, maybe it's Bitcoin. We don't know what's going to happen. But what we can be fairly certain is that 100 years down the line, gold will still have value, because it is fairly scarce in nature and it has been accepted for the past thousands of years. So by the time you and I are dead, it's still going to be fairly valued. So that store of value argument is also there. So these are the arguments for why gold. The other part of the argument is why gold today. All of these things have always been there, but we don't really, have been advocating investing in gold for a very, very long time. Personally, as I'll talk about a little bit later, I started investing in gold maybe in 2021, but I do believe that now is essentially a good time for everyone to build a certain amount of exposure to gold. And I'm not talking about it from a year perspective or 2-year perspective. I'm talking about from a early retirement portfolio perspective. And when you're thinking about a portfolio over the next 20 years, 30 years, 40 years, or very, very long periods of time, you will need to have gold in that. And the big reason what has convinced me personally over the last couple of years is that there is a fundamental shift which has happened in how the world views gold. If we go back around 100 years, I believe in the 1940s, that's when the Bretton Woods conference happened, when the currencies of the world or the dollar was linked to gold. That was a big significant thing that happened. Then in the early 70s came the Nixon shock, when he delinked the dollar to the gold. He so-called freed the dollar from the shackles of gold. So that was again something significant that happened in the 70s. I do believe something significant has happened over the last 2-3 years. We can say that it might have happened because of the Russia-Ukraine war, how Russia has been able to survive with the sanctions. It has, the it is now sort of out of the dollar system of trading, but it's still doing fairly well in terms of an economy. It has been able to survive the economic sanctions. And looking at that, how the sanctions came into the picture, a lot of other countries started getting a bit scared, so to say, or I'll not say scared, but preparing for bad times. And in that, what they have done, especially China, in a huge way, China has started buying gold, and India also has started buying gold, and they have started keeping physically gold in India, which wasn't the case before. And a lot of central banks around the world have started buying gold because the faith in the dollar, while it's still there, is taking a little bit of a hit. And what that means is that whenever such big things happen, people tend to rush towards gold. So maybe gold gives good returns in the next couple of years, maybe it does badly in the next couple of years. But I do believe that over the next decade or over the next 2 decades, gold is going to do significantly well, maybe not as well as equities, but it'll keep my portfolio fairly balanced. My portfolio would not fall as much as it would have if it didn't have gold in it. So just for an example purposes, there is one option which says that you have 70% in equity and 30% in debt, whereas there is another option that says that maybe you have 60% in equity, 10% in gold, and then 30% in debt, or a 60-20-20, 60% in equity or 20% in gold and 20% in debt. I believe the portfolios that have gold in them, they are not going to fall that much when the bad times come in the equity market. And over the long term, they are going to be more or less at the same value at the end of 10 years, 20 years, 30 years, whenever you die. And that's primarily why you should get into gold now, with the central banks pushing for it. There is, again, personally, I am a little bit negative in outlook over the next couple of years for the equity markets. So that's also my personal bias that comes into the picture with respect to gold. The third point is, hope I have convinced you by now to buy some gold. The third point is, how do you actually buy gold? There are various ways. So what you can do is you can actually go to a shop and buy gold physically, which I'm very sure you are already aware. There is digital gold. There are platforms that are selling it. There is gold ETFs that can be purchased, and there are gold mutual funds that you can buy like any other mutual fund. So personally speaking, I do believe that ETFs are the best way in terms of cost. They are exchange traded funds, and you can just buy them like you buy any share or any stock in your demat account. If you don't have a demat account, or if you don't really know how to buy or sell a share, or if you're not comfortable buying or selling shares and having a demat account, I'm not. So what I'm planning to do is I'm planning to buy gold mutual funds. Personally, I've looked at, I most probably get HDFC Gold Mutual Fund, not because it is good or bad, but because my debt funds are lying in HDFC debt fund, so I can just do an STP from there. So gold mutual funds and ETFs is what I would prefer. But that does not mean that buying physical gold is very bad or buying digital gold is very bad. They have certain little bit of extra cost here and there. With physical gold, you might have an issue of, where will you store it? How will you keep it safe? But that's okay. Physical gold has its own advantages as well. You will have it with you on your hand, and there is a certain benefit in it. So whatever, any of these methods that you prefer, most cost effective one, no doubt, will be the gold ETF method. The others you can figure out based upon your comfort. The one thing that you should not get is jewelry, because you pay a lot of making charges in jewelry, and when you are going to sell it in future, it will be looked at as an item of consumption, and there might be some sentimental value that gets attached to it, which might make it a little bit difficult to sell. Personally speaking, for example, I have been trying to convince various family members to sell their diamond jewelry, because I don't really believe that uh, diamond is going to have a lot of value a few years down the line. But I haven't been able to convince them, and that becomes a problem. You get attached to things. Nothing wrong with that, but it's highly unlikely that you're going to get attached to a gold ETF or a gold coin or a gold biscuit or something like that. So as long as you can sell it, good enough. Please go for it. Also, in jewelry, you pay a lot of making charges, so it's not really cost effective at all. So these were the three main things that I want to talk about. That why you should buy gold, and why you should buy it now, and how you can buy it. And now, from a personal perspective, I'll also like to share that what I have done with gold over a period of time. I didn't really have any gold exposure uh, till 2021, 2022, because I believed, and that a lot of people said, a lot of experts said that, gold essentially does not do as well as equities over the long term, or gold is not a productive asset. And while all of those were true, and because I was making money, I should rather put my money into equities. And if you're someone who is earning money and saving money for the long term, equities is the right call for you. But once I got closer to retirement, pulling the plug, living on my portfolio, the importance of stability I started to understand, the importance of gold I started to understand. And that's why I started adding gold in 22ish. Is That's when I was about to retire. Very little amounts of gold, and the product that I used for that was sovereign gold bonds, which I believe were a really, really good product. They're not officially dead, but it's highly unlikely we will see them again. So I started buying sovereign gold bonds. I made a ton of videos on gold, I believe last year as well, where I talked about why invest in gold and how gold is important for fire. So I was buying that every time an SGB came. I bought 50 grams or 10 grams or 20 grams, some amount, and I built a certain amount of gold exposure, but that's still maybe around 2% of my portfolio right now, maybe 3, definitely less than 5. I have not really done the numbers, and that needs to go up. I strongly believe that minimum of 5, maybe 10, maybe 15 is what my gold exposure should be in early retirement. I'm for equity, I typically keep it between 60 to 70%, and rest remains in debt. And that's why I believe that, the equity 60 to 70%, that's fair. The rest, which is there, can accommodate maybe 5%, 10%, or 15% of gold in it. And as someone who is much lesser than that, I need to get more gold. And the way that I'm going to do it is through HDFC Gold Mutual Funds. That's essentially HDFC Gold Mutual Fund. That's a product that I'm comfortable with. I have been buying mutual funds for the last 16, 17 years. So I have complete faith in mutual funds. I've always been able to sell them. And I strongly believe the mutual fund sahi hai tagline. It has worked really, really well for me. So why not stick to something that you know? I don't really know if my choice of HDFC Gold Mutual Fund is a good choice or a bad choice. I haven't done too much research on it. It's simple enough. That's why, because I already have a relationship with HDFC Bank. I did look into it, but I think the Nippon ETF is the best possible way to get it, the cheapest way to get it. So that's also something that you guys should check out. If you believe that I'm doing it right, I should have that 5, 10, 15% in gold in my portfolio, then please let me know via the comment section. And if you believe that I'm doing something wrong, or if you have a very strong objection to my choices like HDFC Gold Mutual Fund or anything that I have said in the video, please do let me know that via the comment section as well. I like to interact with people who comment, at least the ones who comment in a sensible fashion. So I look forward to that. I hope you like this video, and I hope I've earned the privilege of your time. Thank you.